Okay, we're going to get started. Welcome, everybody. Thank you for joining us today for Keys to Financial Management. If you need closed captioning, please click the CC in the bottom or wherever your menu is, and we have closed captioning happening right now that is better than just the automated Zoom closed captioning. I'm going to introduce myself. My name is Liz Fust. I'm the founder and executive director of Gathering Strength, Inc. in Louisville, Kentucky. I have a spinal cord injury and I use a wheelchair, and Gathering Strength empowers people with physical disabilities to achieve better health, to increase self-sufficiency, and to become more engaged in the community. We have a really large group here today, so we are using the webinar function on Zoom, which means you cannot unmute yourself and you cannot turn on your video. You will be able to ask questions through the Q&A function, and you can type a question in there. We do have hundreds of people joining us today, so we won't be able to get to every question right this minute, but we will send out a transcript of the questions and answers to everyone after the meeting. If you want a certificate of participation, please make sure you're using your full name in Zoom so we can track we can verify your participation. You can change your name by hovering over your rectangle and clicking on the three dots and then click rename. If that fails, just put your full name in the Q&A right now so we can make sure that you are attending. If you're unable to type right now, you can feel free to email us with questions or concerns, and we will get back to you or answer those questions after the webinar. We are recording this, and we will make the recording available on our YouTube channel, and we will send out the link to that once we have it uploaded. Also, if you need the interpreters to be larger, you should see a line between the slide and our images, and you can grab that with your mouse and move it one way or the other to make us smaller or larger. So right now, I am going to introduce our presenter today. Her name is Sarah Gardner. She has been a financial counselor with Apprisen for 25 years. She is certified by the National Foundation for Credit Counseling as a credit counselor and a housing counselor, and she is a HUD-certified housing counselor. She enjoys helping people reach their financial goals and improve their financial well-being through counseling, coaching, and education. I'm going to spotlight Sarah, if I can. Sarah, you can spotlight yourself if you can grab yourself and do that.
How do I do that?
The three dots, hover over your rectangle, the three dots.
Yep.
There you go. All right.
Add spotlight.
There you go. You're there.
Okay, great. All right. Well, hello, everybody. Thank you, Liz, for that introduction. And I'm happy to be here today to present the keys to financial management. Let me start by making sure I can get my PowerPoint moving here. Let me start by explaining a little bit about Apprisen. We are a nonprofit agency that helps people with a whole variety of money management and credit-related issues. We work toward what we call the 6 steps to financial health, which is basically budgeting, building savings, paying off debt, improving credit history, building assets, and ultimately, saving for retirement and kind of long-term financial stability. And we're going to cover a lot of those topics in the webinar today. Apprisen works with people both, through these kind of larger financial education venues and also with one-on-one counseling. So any of the things that we talk about today, if you're wanting to get into those further, Apprisen would be happy to meet with you and work on those things with you. And we'll have that contact information kind of at the end of the presentation today. We are going to cover a variety of topics. So we're going to start with the benefits of having a good financial institution relationship, tips for opening and managing your account. We're going to get into a little bit of psychology, talk about money personality before we get into the more mathematics of goal setting and creating a spending plan. And then we'll talk a little bit about the wise use of credit and how to maintain a good credit history. So the last part of our presentation will be really about credit reporting and scoring. Middle part will be about money management. But we'll start out with a little bit about financial institutions. We will stop a couple of times for Q&A and just for you to get a little break from my voice for a minute. So any questions, as Liz said, just put those in the Q&A through Zoom, and we will get to as many as we can in our couple of breaks for questions. So let's move now to talk a little bit about the benefits of a healthy financial institution relationship. So basically, using a bank or a credit union to safeguard your money. And the first benefit of that is the safety of it. So having your money somewhere that is protected from theft, from fire, from, all the things that could happen to cash that's on your body or in your home. And also the benefits, of having the saving time and money, of being able to use all the tools that a financial institution would offer you versus having to run around with cash and money orders and, the things that you'd have to do if you didn't have a banking relationship. So there's lots of ways to track your money. It gives you a lot of tools to have better control over your finances, and being able to pay bills, transfer money, do everything that you need to do financially fairly easily. So I want to talk first a little bit about the different options that you have for the types of financial institutions that you could use. So there's kind of three categories. There's traditional banks, there are credit unions, and then there are sort of more recent online-only options, some what we call fintech or neobanks. So let's start with the traditional banks and the credit unions. So these are usually institutions with brick and mortar branches. Those are getting a little fewer and further between as we get into more of a digital world. A lot of the banks are moving to, more online as well. But this is where you would have the opportunity to actually have a relationship with a person that can help you with your banking and with your finances. Banks and credit unions offer the same menu of services. Each individual bank or individual credit union might have a slightly different set of services that they offer, but they are basically the same thing in terms of providing checking accounts, savings accounts, credit cards, car loans, mortgage loans, personal loans, different longer-term saving options like certificates of deposit. There's really not a big difference in the services offered between bank and credit unions, but there's a big difference in their structure. So a bank is a for-profit entity. It's providing those banking services with the intent of making a profit for its owners, its stockholders. A credit union is a nonprofit institution that is member owned. So when you open an account at a credit union, you're not just opening an account, you're actually becoming a member owner of that credit union. And all of the services that the credit union offers, the same as what the bank would have offered, the profit from that would be sort of folded back into the membership. So credit unions can sometimes have lower fees, lower interest rates when you're borrowing, maybe a little bit better interest rate when you're saving. It's just a little bit different type of relationship that you have with that institution. With both traditional banks and credit unions, your money is protected. Um, if that institution were to go under, your money is safe up to $250,000 through the FDIC, Federal Deposit Insurance Corporation, if it's a bank, or the NCUA, the National Credit Union Association, if it's a credit union. So it's a very safe place to keep your money. The fintech, neobanks, online options don't necessarily have the full scale of services and products that the credit unions and banks do. And they don't necessarily have the same kind of protections in terms of that federal insurance protecting your deposit if that company should go under. So it's a little bit riskier place to plant your money, and maybe fewer options in terms of the services that they offer. Certainly, no option of actually walking in and talking to a person when you have a question or a problem. But those options are out there, and lots of people are using those. Just a few banking terms we want to go over, make sure everybody knows what they're doing when they open that institution so they can be successful in that relationship. Usually when you open a new bank or credit union account, there's a minimum amount that you have to deposit in order to open. It's usually not a huge amount, $25, $50. It's going to depend on each institution. And then many of them also have a minimum requirement that you have to leave in the account. That will certainly be the case if it's a credit union, because you have to buy a share, and that money, basically your share has to stay in the savings account at all times. But it's usually not a huge amount of money, again, probably in the range of $25. Some institutions will have a monthly maintenance fee. So if you can avoid paying that, obviously it's better not to have to pay that. So shopping around a little bit to see what the fees are for different institutions. They're not all going to be the same for sure. And some of them may vary depending on what you need or how you're going to use the account. So, you want to think about the ways that you're going to use your checking and savings account, and what's worth paying a fee for, or what would allow you to avoid a fee. You're most likely, if you have a checking account, going to have a debit card associated with that you can use to make purchases, either in stores or online. They usually have that MasterCard or Visa logo that let you use it as if it were a credit card, but it is not. The money is coming immediately out of your bank account. And you can also use that debit card at the ATM or automated teller machine to get out cash. Deposits, of course, are the money that you put into the bank account. Funds availability is an important thing to be aware of and ask about. Most deposits will be immediately available. If you're having a Social Security check or a paycheck go to your bank account, those funds should be normally available immediately. But sometimes when there's an unusual deposit or from an unknown source, like if a family member wrote you a check, that might not be immediately available when you deposit, or if it's a larger amount, it might not be immediately available while they check to make sure that that check is good. I can't imagine there's any institution that doesn't have a lot of digital account features at this point. So they will usually have free online access either through your desktop or through your phone, through their mobile app, and lots of great services usually through the website, online bill paying, the ability to monitor your statement. Sometimes they have budgeting, templates and features and tracking features that can be helpful for you as well as you're trying to manage your money. And as you open your account, they'll need some ID, so be sure you take a driver's license, passport, military ID. Some might require additional verification like Social Security card or address information, and then whatever your opening deposit requirement is going to be. One of the things you should think about before you go in, because it's a decision you'll have to make as you open the account, is whether or not you want overdraft protection on the account. Overdraft protection is a line of credit, basically a loan that you can draw from as needed, that allows you to make purchases when you don't have enough money in your account. So if you opt in for overdraft, then, if you go over the amount in your bank account, you're going to have to pay that back, and there are going to be fees, and sometimes those fees are high. But it would protect you if you're at a cash register in a store and you're trying to use your debit card and you're a little bit over, you're not going to get the charges rejected. You're going to be able to make your purchase and then, repay that to the institution afterwards. If you opt out of overdraft protection, your debit card would be declined if you don't have enough in your account, but you're not going to be charged any fees or anything. And you can't, you won't be able to get yourself in the hole. Sometimes people get themselves into a pretty deep hole with overdraft protection, having a negative balance in their bank account. And then as soon as they get their paycheck or Social Security check, they're already halfway into it. So if you are worried about that kind of situation, then you want to opt out of the overdraft protection. There are lots of different ways to get the money out of your account to spend the money. You can get cash at the ATM or the teller. You can use your debit card. You could apply for a credit card at that institution. You can use money transfer services like Venmo and Cash App. Lots of different ways. Like I said, online payments through the website or the app. Lots of different ways to manage the money out of the account. And I just wanted to talk a little bit about some ways to keep a good relationship with the bank and keep your account in good standing. So, make sure that you're staying engaged and paying attention, basically. Automate things that, are helpful to automate, like direct deposit. Be sure that you're embracing the idea of having a spending plan, and we'll be talking a lot about spending plans in just a few moments. Try to manage the account so that you avoid fees, basically throwing your money away on fees that you might not have to pay. Protect your account, in other words, don't leave your account information around where somebody might be able to do some identity theft, steal money out of your account. And then once you have that basic relationship with a financial institution of, a checking account or savings account, look at some of the other products that they have. Certificates of deposit are great if you've got some long-term savings that you can leave aside. Credit cards, personal loans, car loans. Once you already have a relationship with an institution, that can often be a better place to do your borrowing. They know you, so they can, maybe more likely to approve you for those products. And you maybe get a better interest rate at your own institution than you might somewhere else. So I'm going to just pause there for a moment, and we'll see if there's any questions.
Yes, there is one question that came up, and it was about the neobank. What that is, and is it a 529A ABLE account through the state, or is it something different?
No, I'm not talking about the ABLE account. An ABLE account, for those of you who may not know, is a special kinds of savings account for people who became disabled before the age of 26. That's going to be expanded to a higher age shortly, but it sort of protects your asset if you're on SSI and have an asset limit. And that is not what I was talking about. Now, on September 11th, there's going to be another webinar in this series, Saving for the Future. And that will talk a great deal about the ABLE account, so I'm not going to get into a lot of detail about it today. But the neobank is a way of doing basically a checking account or savings account through an online company that's not a traditional bank or credit union. So an example is Chime. Where there's no brick and mortar institution, there's no bank you can walk into. It's all online, and you just have a debit card that you use um, to get them. You do direct deposit to the account and a debit card that lets you spend the money out of the account.
One more question, Sarah, although I think you're probably going to get to this, but the question is, which banks or credit unions, if any, provide waivers for minimum opening balances or monthly balances and monthly maintenance fees for Social Security disability recipients?
I can't answer that question because, I don't work for any specific bank or credit union. And so, that's really an issue of shopping around, and finding out what kinds of accounts that institution has, what kinds of fees it has, and sometimes they have a whole menu of different accounts. So, some institutions might have a special account for people who are on Social Security, um, where they charge lower fees. Credit unions in general are going to charge lower fees than banks, but that's not, uniformly true. I know there are some free accounts with banks as well as no fee accounts with credit unions.
Okay,
So
thank
it's really
you.
just a question of shopping around a bit.
Great, thanks.
Mhm. Any other questions, or shall we move on?
We can move on.
Okay. Well, so the next part, before we get into a lot of kind of technical mathematical discussion of budgeting and managing money, I want to veer off a little bit into psychology, because I think it helps to manage your money successfully if you do a little thinking about how your brain works, and how you feel about money, how you relate to money. So, unfortunately, we don't have the opportunity to have that discussion in the webinar format. So I'm just going to throw out some kind of homework questions for you guys to think about. Um, and the first one here is how your personality affects the way that you handle money, right? So we're all individual people, with different personalities, different life backgrounds, different strengths and weaknesses. So, kind of doing a little exploration as to what your own personality and strengths and weaknesses are related to money management can be helpful. So, for example, some people are what we call the lovers and givers, very generous people that are, always giving gifts or helping out family members. They're kind of the magnet for anybody who's having a hard time and, needs a little bit of assistance. Great quality generosity. Not gonna, object to that, but there are people who get themselves into a financial hole because they're generous beyond their capacity to be generous. They're helping other people, and that's not leaving them enough for their own basic needs. You got your impulsive spenders. You've got your people who are more materialistic, people who are less materialistic. One of my personality traits is procrastination, and that can sometimes affect, whether I'm managing my money in the best possible way. So just kind of be thinking about those things and how you can use your personality, your personality traits, either to try to change those habits, or whether there's a way that you can make your habits work for you, where you can kind of psych yourself into doing the right thing. A few more questions to kind of mull over, is how you learned about money originally. what the adults in your life taught you, either explicitly or by your just observing their behaviors. Um, think about the past and what kind of money mistakes that you have made. And I'm going to expand on that a little bit and also think about some of your money successes. You know, what have you done well? What have you done that you regret? How have those choices, those good choices and bad choices affected you up till now? Um, and then think a little bit about your recent spending. Was there a purchase that was particularly satisfying to you, or a way that you managed your money or spent your money that brought you satisfaction? Um, or have there been things that you regret? You know, did you go on that shopping spree and then you came home and you're like, why did I buy this? Um, so thinking about those behaviors, and then a really important thing is thinking about what being financially healthy would look like for you. You know, where are you now? Where do you want to be? How are you going to get there? You know, and what are the step by steps that you can take to get there, right? So if you're thinking, okay, you know, I want to be a saver, and on a scale of 1 to 10, I'm only at a 2 right now, and I want to get to a 10. Well, you're not going to go from 2 to 10. So the first thing to think about is, how can I get from 2 to 3? Right? And then 3 to 4, and ease yourself up. And again, these are all things that Apprisen and some other financial coaching resources that we're going to provide can assist you with. Uh, so last bit of homework assignment related to money personality is a little exercise we call start, stop, and continue. So thinking about something that you're already doing well. Start there. That's not the order on my screen, but start with what you're already doing well and that you're going to continue to do. Something that you're not doing well, you think that's harming you and you want to stop doing, and maybe something you haven't tried yet that you think would be beneficial that you want to start doing. So, just a few things to mull over. Um, So now we'll kind of jump into the more nitty-gritty of money management. Um, and I want to talk first about financial goals, because that's really the cornerstone of money management. It's really important before you do any of this other work to think about what your financial goals are. And then, you know, the budget and the spending plan is really going to be your tool to get you to your goals. But without the goals, the rest of it's just an annoying math exercise. And you know, why do it? Why are you managing your money well? Because you're trying to meet your goals. So having some goals helps you focus. It helps you measure your progress, which can help people like me overcome procrastination. When you get that sort of momentum going, it really gives you that motivation to continue. You know, you want to celebrate the things that go well, and help you to do the next thing well. Um, so one thing that we would suggest, and you've probably seen this SMART before, but when you're thinking about your goals, you want to make them as specific as possible. So in other words, you don't want to just say, I'd like to build savings. You want to say, I want to save $500. Make it a specific goal. Make it meaningful. Okay. Don't just say, I want to save money because Sarah says you should save money, or your mother says you should save money, or society says you should save money. Why do you want to build that savings, or whatever that goal is? Actionable, just meaning you need to come up with a game plan of how you're going to achieve that. You want to make sure that your goal is realistic. So, you know, I could save $500. Given enough time and effort, I could save $5,000. over my lifetime of retirement savings, hopefully I'll be able to save 50,000 or even 500,000. But I'm never going to save $5 million, right? That's just not in the cards with my nonprofit credit counselor salary. So, make sure that the goals that you set are something that you could achieve. Otherwise, instead of being motivational, it's just, depressing. And then timely. Give yourself a deadline, right? Not just, I want to save $500. I'm saving that $500 because I would like to buy a new couch. So that's meaningful to me. And I'm going to do that by setting aside $50 a month. Give yourself a time frame as well. I'd like to save that $500 by July of 2025. I'm going to put a little goal setting worksheet on the screen for you. One thing I would definitely suggest, both with the goal setting and some of the things we're going to do as far as developing a spending plan, is to do it in writing. Put it down on paper to make it real and to be able to remind yourself of those goals over time. I think just a goal in your head is a daydream. A goal on paper is a goal. So this little chart, you can do it in any format that you want to. And one of the reasons that I wanted to talk about money personality is to point out that because everybody's personality is a little different, the methods for doing some of these exercises, some of these tools like a spending plan, is going to be different for everybody. There's no right or wrong way to do it. There's the way that works for you. And sometimes you have to experiment a little with that. If it's just not working, then maybe there's another method that would work better. So this is just an example. It's not something that you have to do it exactly this way. But you may want to break your goals down into short-term, mid-term, long-term. So short-term are the things you're going to do within the next year. Midterm would be 1 to 5 years. Long-term is more than 5 years. So something like, retirement savings might be a long-term goal. Think about what the goal is. If it has a dollar figure with it, then think about the specific cost. Now, your goals do not have to be about a material item that has a specific cost. Your goals could be things like, I want to stop waking up at 2 o'clock in the morning worrying about my money. I want to be financially stable. Can be your goal. It doesn't have to be a purchase. You got a target date. If there is a dollar amount associated with it, then your plan or how much you're going to save monthly or what your action steps are, and just break down things that way. So, I would have a larger sheet for, your big goal setting worksheet. But we also recommend that your primary goal is something that you write down and keep handy so that you're reminded of it when you're tempted to spend your money elsewhere, right? So if you're trying to save for a vacation, for instance, or save to buy an item, put that on a card and put that next to your debit card and be reminded of that every time that you're going to spend money, or put a picture of that thing that you want, that house, that car, that vacation, that couch, whatever it is, remind yourself of your goals frequently will help you to stick to them. All right. So the goal is the first step. The next step is the budget or spending plan, which is the tool that's going to get you to your goal. So when I'm talking to people and, discussing whether they've been a budgeter or not, and how they feel about that term, that's a very stressful, scary concept for some people, and I get that. But I want to make sure that you're thinking about it as an empowerment, not as a restriction. So we're talking about your money here, how you're going to spend your money. That's the choice that you get to make. Nobody's going to, gets to tell you how you spend your money. Um, so it's about you actively making the choices of where you want your money to go and making sure that your spending is consistent with the goals and, what you're trying to achieve. So, as we talk about budgeting, we'll be kind of going through a process of talking about tracking spending, creating the spending plan, and then the importance of adjusting and checking in with that regularly. So, let's start with tracking your spending, right? It's going to be hard to make a budget if you don't know what your expenses are or where your money has traditionally been going. So, we recommend that for at least 30 days and preferably longer, preferably permanently, but at least 30 days that you track every penny that you spend, no matter how small a purchase it is. Either write it down, put it in a tracking app, keep a receipt, do something that enables you to come back at the end of the month and know where every single penny went. And there's two purposes for that. One is to come up with those dollar amounts that you're then going to use in your spending plan. And the other is to look for spending leaks, things that you're spending more money on than you realize. So that might be snacks at the gas station, that might be eating out, that might be groceries, might be clothing. There's lots of different categories. We've had some people who were spending a lot more on video games than they realized because each purchase, was really small. But when you added up all the little tiny purchases through the month, it was a significant amount of money. Streaming services is another one where people often get kind of caught up. You sign up for something, you forget you signed up for it. You're not really using it, but it's still charging you every month. So keeping a real eye on what's going out is kind of the first stage. And then when you go to do your spending plan, and again, this really needs to be done in writing. I've got lots of clients who try to do all of their budgeting in their head. And there's some of that you could do in your head, but you really can't. If you're doing it correctly and really planning for everything you need to plan for, you're not going to be able to hold all those figures in your head. So I really urge you to do it not necessarily on paper, but that's one option, of course. There are lots of apps. There may be some resources available through your bank or credit union, ledgers. There's all kinds of systems that you could use. They're not better or worse. It's the whichever one works for you. But the basic elements in your spending plan are going to be your income, your expenses, your outgo, and the essential element as well of having some savings. So let's start with income. Income's usually pretty straightforward. Whether that's your Social Security check, if you're working your paycheck, if you're retired and getting a pension or a retirement check, if you get child support, whatever sources of income that you personally have. We do recommend that you use only the income that you can count on to make a spending plan that covers all the basic needs. So, for instance, people who are working, we don't suggest that you use your overtime, your bonuses in your basic budget, but still to have a plan for when you do have sort of that extra or variable income, how you're going to use it so that you don't waste it, so that it does go toward the goals that you have. Um, and then, looking at options for additional income. One of the webinars in this series is going to be working while on benefits. So if you are on disability, you are certainly allowed to work. But there's, ways that you need to do that. So we'll have a whole webinar about that subject. Some people are doing a traditional job. Some people are doing odd jobs on the side, renting a room, having a roommate, turning a hobby into money. There are selling things that you already own. There are different ways that you can kind of come up with some additional income if needed. The bulk of your budget is going to be your expenses. So I want to spend the most time on that because this is the trickier part. So some of what's going to go on your spending plan is very easy, very straightforward, and that's your fixed expenses. The things that are every month and are the same amount every month. So for instance, your rent or mortgage payment, if you have a car payment, some things like maybe your cable bill or your cell phone bill that really don't vary from month to month, car insurance, whatever happens every month and is pretty much the same amount every month, that's going to be your fixed expenses. Those are easy. When I give somebody a piece of paper and say, here, write down your budget, that's where they're going to start because everybody's, usually has those more or less in their head. The next layer, which gets a little trickier, is the flexible expenses. So these are the things that happen every month, but are not necessarily the same amount every month. So for instance, groceries probably fluctuate a bit from month to month. Gasoline, utilities, your utility bills between summer, winter, spring, and fall are probably going to vary quite a bit. So anything that's every month, but not the same amount, those are your flexible expenses. Those are usually relatively easy to come up with an amount for. Where we get into the rocket science portion of our budgeting is the periodic expenses. This is where it really gets tricky. Periodic expenses are the things that don't happen every month, but do happen. They may be on a predictable schedule, or they may be on a random schedule. They may be a predictable amount, or they may be a random amount. But they do happen. They shouldn't be treated as emergencies, and it is essential that you have a way of working them into your month-to-month budget so that you're ready when they occur. Because if you're not ready when they occur, then they are an emergency that they shouldn't have been. They may help get you behind on your fixed expenses like your rent, or they may lead to debt. They may be something that you end up putting on a credit card because you hadn't planned ahead for that expense. So what I'm talking about here are things like car maintenance and repair, clothing, unusual medical expenses, dental, that just happens, you just go to the dentist twice a year. You might only need to get eyeglasses once every year or once every several years. Holidays and gift giving is potentially a huge category. Back to school. So we're right in back to school session right now. If you have pets, then vet expenses would be a periodic expense. If you pay insurances not on a monthly basis, so you can choose to pay your car insurance every month, which makes it more expensive. If you're able to save up and pay it every 6 months, then you're going to get a discount and it becomes a periodic expense. So those are just a few examples. There are lots and lots of categories. And if you make a budget that just has the monthly expenses, the fixed and the flexible, and you've pretty much accounted for all of your income with the fixed and the flexible, that's not going to work. And so I think a lot of times people who have been really frustrated with budgeting and just can't seem to make it work or figure out how to do it, it's because they're not budgeting for the periodic expenses. So there are different methods for how you would do that. Again, not a right or wrong as long as you're doing it. So one option would be, for instance, you could say, okay, these are my annual amounts for these periodic expenses. This is what I'm going to budget myself for the year for clothing. Or this is what I'm going to budget for giving people gifts. Or this is what I typically spend at the dentist, so I'm going to set aside for the dentist. All those categories, come up with an annual amount, add all those annual amounts together. Then you have a huge annual amount at the bottom line there and divide it by 12. And that's your monthly budget for your periodic expenses. And I would suggest you probably should put that into a different account. So you might, have a special savings account just for those periodic expenses. But keep in mind that this is not really savings. So the other thing that I often encounter with people who are frustrated by their inability to build savings, it's because they're not really building an emergency fund, or they're not really saving for that special thing. They're really just setting aside for periodic expenses. So they're constantly withdrawing from their savings because these periodic expenses are going to be constantly coming up. So don't think about this as savings. Think about it as a set aside, and give yourself permission to draw from it as these things come up, and try to have a separate bucket in which you actually build savings. So I want to talk about that next, because that is really an essential piece of successful money management, and feeling financially secure, and not waking up at 2 o'clock in the morning and worrying about money, right? Is to have some savings. Savings is tough. I understand that, particularly if you're on a fixed income, and expenses tend to expand to take all or more than what you've got coming in. But it's still essential to have some savings. Um, and I think savings really has two pieces to it. One is the dollars, and the other is the habit. So having the habit of building savings, having the mindset that, yes, I can save, and yes, I will save, is really more important than the dollar amount. So start small, create the habit first, become a saver. And there are savers at all levels of income, right? So it's not about income. At some point, it's also about habit. And just start small. If that's $1 a month, then it's $1 a month, right? You're not going to miss $1 a month. Just get in the habit of, you always set that dollar aside, and you never go and take it back out. And then once you got the habit with $1, then you can, try to make that $5. Then you can try to make that $20, whatever you have the capacity to do. As long as you keep doing it, even a small amount is going to add up. So automating that savings is one way to make that a habit. So if you are getting a paycheck, you can split your direct deposit between the checking account that you're going to spend money from, and a savings account that you're not going to spend money from. Or automate a transfer. If you are working with a bank or credit union, you can probably go through the website and set up an automatic transfer to when your Social Security check deposits to the bank account, that automatically that dollar or that $5 transfers over. There are plenty of apps out there. Everything that we're talking about today, there's an app for, I promise you. For some people, the envelope system is the most successful system, where you're actually putting cash in an envelope, either for emergency savings that we're talking about now, or as a way to handle your periodic expenses. You've got an envelope for clothing, you've got an envelope for holidays, you've got an envelope for car repair. Save your change. Look for ways to reduce spending so that you can put a little bit more into the savings, like at the end of your grocery store trip, take out one item and put that, that amount aside. So when you go to put all this on paper, and you've got your income, your savings, your expenses, you do all the math, almost always in the first draft, that bottom line is going to be a negative, right? At any income level, usually your wants are going to be greater than your capacity. So if that turns out to be the case, and your expenses are more than your income, then you got to find a way to balance that out, right? Either decreasing the expenses or increasing the income. If you're that lucky person who has more income than expenses, fantastic. You can add some goals, you can pay down some debt, you can build more savings. That's great. But just be aware that that's not something you did wrong. It's very rare that I work with somebody on their income and expenses and that the first draft is not in the negative. But it needs to get out of the negative um, to make your life reasonable. So, Liz, we did not have this as a point for questions, but I think maybe this is a good place to pause for just a second and see if there's any questions specifically about the spending plan.
Yeah, there is a question, and it was, well, there were two, but let's see. How does spending and budgeting work with limited or low income and being able to spend on basic needs, not extras? I don't know if you
Yeah.
want to speak to that a bit.
I can. I don't want to downplay how tough it is to live on a fixed income because I know it's tough to live on a fixed income. But, in my 25 years of counseling, I will tell you that it is a struggle for people at every level of income. And some of the worst financial messes that I have seen have been with my higher income clients. So i- again, I don't want to downplay how tough it is, but I also don't want to, have that be, a total excuse for, oh, I can't do a budget because I don't have enough income. Well, you still need a spending plan. And even more so, if you don't have a surplus income, then it is all the more important that you're tracking your expending, that you're knowing exactly where that's going. And yes, if you have a low income, probably a much greater percentage of your income is going to go just for your basic needs. And you may not be able to do a whole lot of the wants and the, extra goal setting. And, unfortunately, that's just that reality. Um,
And the only thing I'll add, Sarah, which you've already mentioned, is a plug for our second workshop on September 11th, which will be about savings plans that are available for people who are on means-tested benefits, and how you can save, and that'll be much more detailed than we can get into now.
yeah. And, I'm sure there are many people on the call who just physically health-wise could not work with their disability. But if you are able to, even a little bit, there are opportunities and options, and it can make a big difference to have that little bit of extra income on top of your disability. So I would also encourage everybody to take the webinar on October 9th and learn more about the options for working while you're on SSDI or SSI. All right, well, let's move on and talk. We've got about half an hour left and a lot of territory to cover. So let's move on to talking a little bit about the wise use of credit and managing your debt and keeping a good credit history, credit score. So, um, I like to talk about to people, have a discussion of, whether borrowing money is a good thing or a bad thing. And the answer in my mind is that it's not inherently one or the other. It is a tool that can be used, wisely or unwisely. But what you have to think about when you're borrowing money is that you are accepting that you will be paying more for something in order to have it sooner. I mean, that's basically what borrowing is. You're going to pay interest, so by the time you finish paying something off, it's going to have cost you more than the sticker price. So is it worth that true cost in order to have it sooner versus, waiting longer, saving up the money and buying cash and just paying the sticker price? One of the things that I think makes that worthwhile or not worthwhile is thinking about the value of what you're buying and whether it's an investment or just a cost. So for example, most people are never going to be able to buy a house without taking a mortgage, right? And if you take a mortgage, you're going to pay a whole lot more for the house than what you actually paid the seller at the time you bought the house. By the time you finish paying off the house, you've usually paid twice that much or more. On the other hand, you've had a place to live for those 30 years that you were paying off the mortgage. And at the end of that 30 years, if you were to turn around and sell the house, it's now worth usually a lot more than you paid the seller when you bought it 30 years ago. So, most people, if they're able to do so and want to be a homeowner, would say, yes, the extra cost is worth having this house sooner because otherwise I'm never going to have this house. Student loans are another example that are a potential investment. Doesn't always work out that way, but the theory is that the education that you've paid for with the student loans has increased your income capacity and is worth the extra cost because of that extra income capacity. Many people do the same thing with purchase of a car. You pay a lot more than the car is worth if you get a car loan. And the car does go down in value instead of going up in value like a house. But it provides other economic opportunities, both for cutting costs and potentially increasing income if that enables you to work, that make that worthwhile. On your screen is an example of borrowing that may not be worth the true cost. So I've got an example here of, let's say I bought a $500 television with a credit card with an 18% interest rate. If I make just the minimum payment back to that credit card, it'll take me 5.5 years to pay off that television, and I will have spent $751, right? So is that TV worth $750 to me? Maybe, maybe not. The more you borrow on short-term debt like that, the worse that ratio gets. So if I've spent $2,500 on my 18% credit card and just make minimum payments, it will take 12 years to completely pay it off, and it will have almost doubled the price. And where it gets really bad is when people who have kind of perma-debt on their credit cards, they're always carrying a balance. And so you're just kind of adding to that initial purchase and both never paying off and doubling the cost of everything you've bought. So let's say you had bought $2,500 worth of furniture on that credit card and you've paid it down a little bit, but then you use that credit card to go to McDonald's, right? Your $10 McDonald's meal is going to cost you $20 by the time you've paid it off 12 years later, and you've long since forgotten that you ever went to McDonald's. You may still be using that furniture, but you're not enjoying that McDonald's meal anymore. Right? So you got to think about kind of the long term of what you're using credit to buy. And you want to be careful about what percentage of your income that you are committing to debt repayment. That's the other aspect of debt, kind of the other definition of debt in a sense, is that when you're borrowing money, you're committing future dollars to that thing that you're getting today. So you are limiting tomorrow, next week, next month, next year's choices about how you're going to spend your money because you've already committed it to that debt repayment. Definitely, you do not want more than 15 or 20% of your net pay to be committed to debt payment. Now, that's not including a mortgage because that's the housing cost kind of falls into a different category, but student loan, car loan, credit cards, personal loans, those should definitely stay within 15 to 20% of your income. And less than that would be better. I mean, that's the extreme. That's the worst it should get. If you have a lot of debt, I want to just kind of run through some options for repaying debt. if you've got a number of different debts that you're trying to take care of, the method that I most often recommend is a debt snowball, where you kind of figure out all the debt that you have, find the smallest debt, put every extra penny you can to that smallest debt. Be sure you're maintaining the minimum payment on everything, but the smallest balance only gets any extra. You're going to pay off that smallest debt pretty quickly because it's small. And then you're going to have some extra money from the minimum payment you're no longer making to that debt that you can roll over to the second smallest debt and just keep kind of working your way up. Um, the reason I usually recommend this method is that it is the most psychologically satisfying, because you're going to really see your progress quickly, and that's going to be motivating to help you continue. A debt avalanche starts at the other end. With debt avalanche, you're picking your worst debt in terms of uh, either balance or interest rate or interest charge or payment, and all your extra is going to that worst debt. Because it's going to be a large balance, you're probably not going to see that progress soon. And so it's a hard, long slog to get rid of that first debt. But once you do, the rest of the debt is easy, because now you've got a lot of extra money every month and you can just really wash away all the rest of the debt pretty quickly. Debt management program is a service through Apprisen and other credit counseling agencies, specifically primarily for credit. Then Apprisen makes the payment to the credit cards, and the credit card companies reduce their interest rates to help you get paid off faster. Consolidation is where you take a loan, you use the new loan to pay off the old debt, and then you just repay the new loan. Kind of helps make things easier with the one monthly payment versus multiple payments, but you really want to do that only if the consolidation loan is a better interest rate. Debt settlement is something you can do if you have collection debt. Debt that's already in default will usually take less than what you actually owe, but you usually have to have that money up front. So that's something where you need to save up. Instead of making payments, you save up and then you call and offer a portion of the balance. And I've seen them take usually anywhere between 30 and 60% of the balance as a settlement. Settlement's not quite as good for your credit score as paying in full. And the money that you don't pay can be considered income by the IRS. So there may be some implications there. But it is a good way, if you've got a lot of collection debt, to get rid of it faster for less money. And then the ultimate solution, if you can't repay debt in any other way, there is the bankruptcy option, but that should always be the last option. Definitely want to caution you in terms of borrowing, that you're careful about what we call the quick fix. Borrowing money to get yourself out of an emergency is usually not a good idea. It usually comes at a very steep price. For instance, if you were to do a traditional payday loan, at a brick and mortar payday loan store, those interest rates effectively were 200 to 400%. What is much more common nowadays are online loans, and they are rampant. We hardly ever talk to people anymore that don't have some really horrible online loans. Those sometimes have interest rates at 700 to 800%. So be very, very careful. Anytime you're borrowing money, be very, very careful that you're understanding exactly what the terms are of that. But and, if you've been using borrowing to get yourself out of a crisis, it's probably not going to be a long-term solution. You're going to be back in that crisis the next month and the next month and the next month. So just be super careful of. So kind of some final words on money management. Just be sure that you're checking in regularly. It's not a one-step process and then you're done. be very flexible. The budget is never going to come out exactly like you planned. This is real life, not some, theoretical um, situation. So, don't get frustrated if it doesn't come out exactly the way you planned, but use that as a tool to make the next month's version stronger, right? You learn from what went wrong, analyze what went wrong. Did you forget a category? Was it a periodic expense that you hadn't allotted for? What was it that got you off track? Or was it your behavior? Did you budget $50 for eating out and spent 150? Figure out what went wrong and use that to do better the following month. Revise your goals, check your credit history, kind of be aware of what's going on. I beg you to read your monthly bills. It is so easy with online billing these days, where they're not mailing out a detailed bill, to not see what all your charges are. But it's important that you do so. That you're checking for mistakes, that you're checking for services that you didn't really need to receive. So don't just click on the pay now and make the minimum payment. Open up the bill, read through the bill, decide what needs to happen. All right, so the rest of the time, I want to talk a little bit about credit reporting and scoring. But before we get into that, let's just open it up for if there's any other questions at this moment.
Well, I don't think there's a question we have to do right now. I think probably better to save it till the end. That's okay. And it's 3:07 right now.
Okay, yep. So let's roll on and rip through the credit reporting and scoring here. So, credit history is really important for a lot of different reasons. Your credit score is going to affect your ability to borrow. It's going to affect whether you get a yes or a no. It's going to affect the interest rate that you get. But even if you don't plan to be a borrower in the near future, it can affect a lot of other choices that you have. It will affect you with landlords. It will affect your insurance rates. It could affect you on the job market. Um, so it's good to have a good credit history, even if you're not planning to borrow money, but it's especially important if you are anticipating the need to borrow money down the road. So there are three major credit reporting agencies: Equifax, Experian, and TransUnion. These are three for-profit companies working in competition with each other. They don't necessarily have exactly the same information. But basically what the credit reporting agencies are doing is collecting data about our borrowing behaviors, and then, kind of providing that, selling that back to people who want that information, the future lenders, the landlords, the employers. So what's on your credit report, of course, is just some identifying information. The main body of the credit report is going to be a listing of your borrowing history. So anytime you took a loan or opened a credit card, um, it's going to show who you borrowed from, how much you borrowed originally, where your balance is today, what your payment amount is, and how you made your payment from month to month to month to month. So were you on time, on time, on time? Were you on time, late, back on time? Were you on time, late, later, latest? So just that history of your payments when you did borrow money. So that's what's normally on the credit report, is when you actually sought out to borrow money. You got a mortgage, a car loan, a student loan, a credit card, a store card, a personal loan. You went and, did an application and borrowed money. Sometimes we don't start out borrowing money, but we end up owing a debt. So for instance, if I go to the emergency room, I've not gone to the emergency room to borrow money, but I may end up owing a debt to the hospital. So medical debt is one of the most common. Another very common example of this that I see on people's credit reports is when you take a service, cell phone, cable, dish, something like that, and in order to get a special price, you agree to keep the service for a particular period of time. So you're signing up for a year or 2 years or what have you. And then for whatever reason, you don't keep it for that length of time. So you may have had a very good reason for stopping the service.
Sarah. Well, Sarah has frozen. Okay. If we can't get her back, I have resources that I can share. And I know there was construction going up. Yeah. Okay. So I'm going to share this PowerPoint. Whoops.
Are we back?
Oh, good.
Yeah. I'm sorry. I don't know what happened there. I don't know. Did I lose it or did everybody lose it?
No, you froze and then you left.
Oh,
So
okay.
I was going to share the PowerPoint and just do the resources.
Okay. At what point did I freeze? I was talking about what's on the credit report.
Yeah, we're real close to we've got about 5 more minutes and then we can get into questions. So if there's
Okay.
some highlights that you want to,
Okay.
because I definitely want to talk about the resources that are
Yeah,
specifically for people with
definitely.
disabilities too.
Okay. So, those collection things could show up on your credit report.
Do you want to share your screen?
Oh, I'm sorry. I do want to share my screen.
There it is.
Okay. Is it back?
It is, although we've got the note slides with it
Oh,
instead of just the
okay.
slideshow.
I shared the wrong screen. Yep, I sure did. Okay. Is that better?
There you go. Yep.
Okay. All right. So on your credit report, again, it's going to be the listing of mostly of where you've gone out to borrow money. But there may be other collection debts for things that, where you didn't start out borrowing money, but you end up owing money, medical bills, cell phone bill, old leases if you had to break a lease, or utilities if you left someplace and didn't pay your last utility bill. So those are always on as a negative, and it is important to get those paid off if you can. In general, positive information will stay on your credit report for 10 years. So if you've paid something on time and pay it off, it's still going to stay on your credit report because it's a history. It's going to stay for 10 years. Negative information stays for 7. So a collection debt will stay for 7. If you were paying on something and then fell behind and it charged off or defaulted, then it stays for 7 years from when you first fell behind. So most negative information will only stay for 7 years. The exception would be a Chapter 7 bankruptcy, which stays for 10 years. All of the data that's on the credit report is crunched together to give you a score, and that score is supposed to predict your credit risk. So I just want to kind of briefly talk about what goes into your credit score. The most important part of your credit score is your payment history. So nothing helps you more than paying on time. Nothing hurts you worse than paying late. So, keeping things current, getting things current, keeping things current is the best thing you can do for improving your score. The second biggest part of your score, and it's almost as important, is the amount of debt you have compared to what you originally borrowed or could have borrowed. That's a little bit important when we're talking about an installment loan, but it's really important when we're talking about credit card debt. It starts to hurt your credit score when you use more than 20% of your credit limit. So nothing can help your credit score more than having an open active credit card that you're paying on time, but it also needs to be at a low balance, and it's fine to have it at a zero balance. That will be helping your credit score. It will still show an on-time payment, and you'll have that great ratio. Um, Types of credit used is another important part of the score. That ratio of installment loans versus revolving or credit card debt. Having something open for a long time is good for your score. Having something that you haven't had open for long at all is usually bad for your score. You know, you'll usually see a dip when you first open something, and then you'll recover, and ultimately it could help you to improve. So I'm going to skip a few slides here so we're running out of time. So basically, given what's goes into your credit score, the top 5 strategies for improving your credit score will be paying bills on time, reducing the level of debt, paying off collection, lowering balances on your credit cards, opening and applying for new credit only when necessary, and then be sure that you're checking your credit report regularly for accuracy. There are often errors, and you want to get those fixed ahead of time and not when you're trying to actually use your credit score for something. If you're trying to establish credit, there are some different ways you can do that. Using a cosigner. If you're the borrower and somebody else is the cosigner, great. If somebody is asking you to cosign, I would suggest your answer is no. If you can't get approved for a regular credit card, you can do a secured credit card where you put a little cash deposit down that they use as collateral. And as long as you handle the money, the credit card properly, they would eventually provide that deposit back to you. Credit builder loan is another way. And again, if you've got that good relationship with a financial institution, your bank or credit union can help you with credit establishing accounts. All right, so I'm just going to skip right ahead to some of the resources because I know we wanted to get to those and get to questions. This is Apprisen's website and main phone number. But I also wanted to share with you some local resources. If you've had bank account problems in the past and are trying to establish a new account and you're having trouble establishing a new account because of previous problems, Bank On is a program that helps with kind of fresh start accounts. And you can find some of those if you're in the Louisville area for bankonlouisville.org. If you are elsewhere in the country, a similar program I can guarantee exists in your community. So you would just want to kind of look for Fresh Start or Bank On type accounts. There is a partnership that a few local agencies have with the National Disability Institute to provide one-on-one counseling and coaching for people with disabilities. So Apprisen is one of those agencies. The Louisville Financial Empowerment Center is another. And so we've got the resources here. The Louisville Financial Empowerment Center is just Louisville. Apprisen counsels nationally. So if you're not in Louisville, you can call this 502-267-8038 is a special number that we have just for folks with disabilities who want to come through the free services. The National Disability Institute would cover the cost of any services that we would provide to you. So use that special number or email coachinglou, L-O-U, like in Louisville, coachinglou@apprisen.com. But again, you do not have to be living in Louisville to take advantage of those services if you are disabled. The National Disability Institute's Financial Resilience Center has lots of really great resources for budgeting, savings, all kinds of financial management topics. So I would urge you to go look through that material. The National Foundation for Credit Counseling is the umbrella organization for Apprisen and other credit counseling agencies throughout the country. And then again, NDI's Apprisen special phone number for disability counseling. And this PowerPoint is going to be made available, so you don't, if you're not able, as we go through these slides to catch it, you could get a copy of all this. And then the future webinars, I'll let Liz maybe wants to talk a little bit more about those.
Sure.
Coming up on September 11th and October 9th, and then I think we'll see if we have one or two questions.
Yeah, great. Thanks, Sarah. The Saving for the Future is on September 11th. I've mentioned it before. It is Saving for the Future for people with disabilities. It will be led by an attorney, Amy Doherty, who is a person with a disability, and she's been practicing law for nearly 40 years and has a lot of experience both with ABLE accounts, and special needs trusts as well. And then on October 9th, we will have a workshop called Working While on Benefits. It's led by a certified work incentives coordinator at the Center for Accessible Living in Louisville. His name is David Edwards. So that'll be a good one if you have clients who want to work but are on SSI or SSDI. And is there another slide after this?
I don't, let's see.
Nope.
There's just a thank you.
Oh, just a thank you. Well, thank you, Sarah. Let me ask you a question that came up, and I'm not sure I know exactly. I think this has to do with the credit score. And it was, I've always known it as 30%. Did it change to 20% at some point, or was I incorrect this whole time? Do you know what that's referring to?
Yes, I do. So I think they're referring to the utilization ratio on a credit card, how much of your limit you can use before it starts to pull down your score. And I always heard 30%, 30%'s out there all the time. And then I took a class directly with FICO. FICO is the company that does the scoring, and they said 20. So I'm taking their word for it.
Great. Here was a question from a little further back. How would you track tips for income? Only count base pay or average out tips per month?
I would average out tips per month, because if you only count base pay, most servers, I mean, that's not going to be anything, right? That's not your income. So with tip money, there are some sources of income that are just trickier to deal with. Tips is one of them. Anybody who's self-employed, that's another, because your income, could be very different from one month to the next. So I think really the only thing you can do is try to go by an average. And it's also tricky when it's tips and you're getting all this like cash in dribs and drabs. It's really easy to just spend that and not really like put it into your whole spending plan. So I would recommend to people that they do collect and deposit their tips and treat their tips, more like a paycheck, and budget it like they would have if that was a paycheck. And whatever your average is. So if your average is $100 a week, and this week you made $110 in tips, have a system where you're putting that extra $10 aside somewhere, so that next week when your tips are only $90, you've still got $100 to work with. Same if you're self-employed. Once you figure out your average, when you make more, put it aside so that you can draw it out when you make less.
I think the only other, this isn't a question, but one thing that has come up, people asking about saving or how they can afford to purchase certain things, medical things, whether it's a wheelchair or some piece of assistive technology. And in many states, there are assistive technology loan funds for people with disabilities.
Mm-hmm.
And Kentucky had one, but they sort of lost the bank. But now the Appalachian Assistive Technology Loan Fund is online now. It started this month that they were able to start taking loans. I just got an email this week. So in Kentucky, the Appalachian Assistive Technology Loan Fund is out there. And in your state, Sarah, confirm if you agree that you could Google assistive technology loan fund and something might pop up.
Yep. And that National Disability Institute, I haven't spent hours memorizing their website, but I would bet you anything you could link to it from there.
Great. Probably, yes. So anyhow, folks, I'm sorry for the clunkiness of tracking your participation by having you put it in the Q&A, but if we have gotten everybody's name in that Q&A, so we will be able to send out certificates of participation, and then in the emails we sent out, and I'm happy to send out another informative email, we included a link to instructions about how you secure those continuing education credits. So feel free to email us if you have questions. I want to thank Sarah Gardner from Apprisen for this great presentation, very informative. Thank you very much. And I want to thank Derek Fraser and Sequoia Jackson, our ASL interpreters, and Laura Kogut, our captioning expert. And we thank everybody for joining us today, and we hope we'll see you in the next 2 workshops. Thanks, everybody.
Thank you.